Good afternoon and welcome to the Nelson A. Rockefeller Center at Dartmouth College. My name is Ron Scheiko. I'm the Associate Director of the Center. This afternoon, the Center continues to celebrate the statewide Martin Luther King Day and with a public lecture from a distinguished Dartmouth alumna, Stephanie McHenry. The title of Stephanie's talk is Banking to Change the World, Creating Jobs and Empowering Communities. This topic cannot be more timely as the federal government wrestles with righting the economy and also solving the banking crisis. Policymakers in Washington are in the midst of formulating new banking reform proposals in the aftermath of the colossal failures in the banking industry. And of course, these negotiations take place within the partisan discord all too present in Washington today. In addition to blaming the banks themselves, policymakers of both political stripes have blamed the actions of the opposing party for the current state of the banking industry. Democrats are quick to blame Republicans for the passage of the 1999 Financial Services Modernization Act that dismantled the Depression-era Glass-Steagall Act's prohibition on mixing commercial and investment bank functions. Meanwhile, Republicans point to the changes in the Community Reinvestment Act orchestrated by the Clinton administration as the main culprit. They argued that the changes forced banks to make unsound loans in the name of ownership for minorities and low-income Americans that resulted in a rising tide of foreclosures. What seems to be lost in all of this fervor over banking failures is the fact that some banks have played by the letter and spirit of the laws and rules promulgated by Washington and have managed to survive and even thrive in the midst of the crisis. These banks, found here in the Upper Valley and all across the nation, are those that have managed prudently, invested pragmatically, loaned to clearly defined constituents in a mission-driven manner. In fact, many of these banks have done well by doing good. Shore Bank is one of those banks. Since 1973, Shore Bank has pursued its mission to invest in people and their communities to create economic equity and a healthy environment. As a for-profit regulated banking institution, Shore Bank has used lending and deposit tools to focus on resources and on challenged urban neighborhoods. This concentration of capital is intended to return healthy market forces to underinvested areas. Residents benefit from job creation, appreciation in real estate values, and a healthier environment. Stephanie's presentation will describe how Shore Bank has done this work, including how it involves local leaders and uses best practices to address unique community needs. Stephanie McHenry is the president of Shore Bank, Cleveland Region. Shore Bank is the nation's first and largest community development and environmental bank with $2.3 billion in total assets. Since beginning work in Cleveland in 1994, Shore Bank has invested more than $300 million in the greater community neighborhoods, greater Cleveland areas, neighborhoods. Prior to joining the bank, Stephanie has served as the Senior Director of Minority Business Development for the Greater Cleveland Growth Association, where she led its successful efforts to support minority business growth. As an active board member, she is past chair of the board of the National Cooperative Bank in Washington, D.C., and served on local governing bodies as well, including those of Cleveland State University and IdeaStream. She is also a member of our Nelson A. Rockefeller Board of Visitors. Stephanie is a member of the Leadership Cleveland class of 2003, and in 2007 she was profiled in Crane's Women of Note feature and received the YWCA Women of Achievement Award in 2008. Stephanie is a 1984 graduate of Dartmouth College with a bachelor's degree in economics. Ladies and gentlemen, please join me in welcoming Stephanie McHenry.
Thanks for that. Thank you. Good afternoon. And thanks, Ron, so much for that great introduction. Since I'm talking to a Dartmouth audience, I thought I'd give you a sense of how I got here in the first place, and then also maybe some of how I got back here to talk to you today. So I grew up in Little Rock, Arkansas, and I was sitting around the table my senior year looking through letters from colleges, because I guess I did pretty well on the various tests, etc. So there was one from Dartmouth. And in walks a family friend that I promise you only comes to our house like once a year, all right? So he happened to show up that day. He saw the Dartmouth letter, and little did we know, he actually went to Dartmouth and then to Thayer. So he grabs the letter and he says, oh, it's a great school, wonderful experience. Here, let me sign my name. go ahead and apply. So I said, okay. Far cry from what students do today, I'm sure, to decide a college, but nonetheless, that was back in 1980. So I got in, and I was like, wow, this is a great opportunity. Now, my parents are first-generation college goers on both sides, so the thought of an Ivy League school was not something that we talked about very regularly. But when I thought about it, I thought it was a great opportunity, first of all, to get 1,000 miles away from home. Thought I knew it all at that point and could do it all better, you know, kind of far away from my parents. And also to experience a different part of the country. And then when I got here and figured out, you know, had that first economics class, and, you know, it was like this light bulb came on. Wow, so this is how the world works. This is why people make certain decisions. And I knew that I had made the right choice at that point. So then I decided, okay, I've got this high-fired, you know, Ivy League degree. Now I'm going to go about making a whole bunch of money somehow, somewhere. So ended up down in Dallas. The Southwest was hot back in the mid-'80s. So went there, and I was selling annuities, you know, deciding to be a full-time capitalist, take advantage of this great opportunity I had to go to Dartmouth. So I get a call from a family friend who starts telling me about this bank that they're trying to bring to Arkansas. Well, it just so happens that he was then the president of the Winthrop Rockefeller Foundation, Nelson's brother, who was governor in Arkansas for a while, and who had endowed a foundation to work on economic issues in the state. So he's telling me, you know, you should come back and think about working with this bank, because all of Arkansas's best and brightest always go away, and they never come back, and that's why the state's in the condition it's in. How many of you youngsters have heard that brain drain speech yet? You will. They'll come back at you like that. So I said, all right, you know, I'll do it. And that was really the first time that I realized that you really could further your career and give something back without necessarily sacrificing. So I think my work at Shore Bank is part of why I'm back here today, and I want to try to share with you some of what I continue to be excited about when I think about a career that does good while doing well. All right, so now the Shore Bank practices serve as a model for responsible and sustainable banking in our urban neighborhoods. This type of banking is sorely needed throughout our country. It can be both a great tool to lead inclusive economic recovery and serve as a sustainable model for the financial services industry. Now, suppose there's no one in the audience today, students, faculty, community residents, who hasn't been impacted by the subprime crisis and subsequent recession. Many graduates will have a tough time finding a job with an unemployment rate of 10%. While perhaps faculty members and local residents with us today have family members who can't find work or have a home they can't sell. Few are immune from the effects of the Great Recession, but it's much worse for African Americans, where unemployment is more than 18%, where home values have declined by 50% over the last 12 to 18 months, leaving record foreclosure rates that are devastating these neighborhoods and the lives of working families and individuals. Between unemployment, a significant drop in real estate values, the tsunami wave of foreclosures, and a lack of credit, there's a whole generation of African American wealth that is disappearing. Due to the irresponsible banking and flood of easy credit that took place in our recent past, all bankers, even those who did things the right way, now face very challenging issues. Credit needs to flow now more than ever to help reverse this trend, but many banks can't, nor will they risk further hits to their capital or weakening assets. As bankers, our jobs are challenging because what we do has become so politically charged. It used to be the lawyers, right? We see politics every day in the hearings on Capitol Hill and on cable talk shows. Banking has become so political that even to my surprise, the fictional Bailey Building and Loan in the classic movie, It's a Wonderful Life, has come under fire for giving out too many mortgages. At Shore Bank, we inspired a worldwide community development banking industry, and we're recognized as the nation's first and leading CDFI, or Community Development Financial Institution. To illustrate, let me give you a sample of what others have said about Shore Bank. Former President Bill Clinton has called Shore Bank the most important bank in America. He was a strong supporter of Shore Bank coming into Arkansas and gained respect for the model for the work we did there in the late 1980s. The industry's foremost publication, The American Banker, said in 2007 that over 3 decades, Shore Bank has become the gold standard of community development banks. The same year, U.S. News and World Report named 2 of our executives and co-founders among America's best leaders. In 2008, Newsweek said we were an ethical subprime lender and noted that the type of work we do is a risk worth taking. And in 2009, the American Prospect called us a model for CDFIs across the nation. So I welcome this opportunity to elaborate on those headlines and share with you some of the ways that Shore Bank approaches the business of banking. For 36 years, Shore Bank has done business for social good, making loans that other commercial banks would not make, the loans which created the economic opportunities that catalyzed social change and revitalized the low and moderate income minority communities that we serve. Hence, the community development banking movement was born on the south side of Chicago. We set out to demonstrate that banks can have a heart and a soul as well as profits. Shore Bank was created in 1973 to find ways in which the mechanisms of capital can be harnessed to achieve social purposes and community benefits. In other words, the bank is committed to providing its customers with the financial services, information to build appreciable wealth and stronger, healthier communities. Our banking model addresses these issues because we believe that making capital accessible in a responsible manner releases entrepreneurial energy. By concentrating resources in neighborhoods suffering from disinvestment and neglect, banking can cause market forces to return to a healthy level of activity. Investment in local residents and businesses triggers additional investment, and the result is the creation of vibrant, sustainable communities. So the bank founders were community leaders who were active in the civil rights movement. They fought the practice of redlining, which was at that time a legal way in which to deny credit and financing to minority neighborhoods deemed too risky. They led the charge, and we were the only bank testifying in support of the Community Reinvestment Act of 1977, which finally banned redlining. Shore Bank began by lending to residents who wanted to buy and renovate single and multifamily houses and apartment buildings. We used conventional mortgages to finance rehabbers. So maybe it was a school teacher looking for a way to afford a new home. So to make it work, we helped her buy a 3-flat property, and we continued working with that person, sharing resources like names of certified rehabbers and financial literacy and management services that would ensure that she would become a responsible building owner. That way, she earned the extra income to afford a new home, created additional units of quality, affordable housing, and strengthened the community. As buildings were restored and came back to life, so did shopkeepers who opened their small businesses and retail outlets to service those residents. Along the way, we established several not-for-profit organizations to help provide job training and other programs to catalyze additional investment. These organizations made loans that served as seed money, which leveraged private investment and created additional economic opportunities. So today, ShoreBank operates in 3 states, Ohio, Illinois, and Michigan, and has assets of more than $2 billion. An affiliate of ShoreBank, ShoreBank Pacific, operates in Oregon and Washington state. And we have affiliated nonprofits in these Midwest cities, the Pacific Northwest, and the Upper Peninsula of Michigan. In the Midwest, our bank has invested more than $3 billion, creating 12,000 jobs and 52,000 units of affordable housing. We've been credited with saving and revitalizing many of the neighborhoods in Chicago's South Side. ShoreBank has also applied its banking approach in global markets. At the invitation of the Rockefeller Foundation, ShoreBank International worked with Muhammad Yunus in Bangladesh to help him design the Grameen Bank for micro-lending in the early 1980s. Yunus and the Grameen Bank were jointly awarded the Nobel Peace Prize in 2006. Recently, SBI received a $5.5 million grant from the Gates Foundation to create and promote savings accounts for the very poor in Southeast Asia. And we were also among a handful of financial institutions chosen to explore new ways, like mobile technology, to provide access to savings accounts for 11 million people in Africa, Asia, and Latin America. In total, ShoreBank International has been in more than 75 countries, helping banks and microfinance lenders make loans to individuals and organizations either too small or too poor to access credit. The company has raised more than $130 million in debt and equity vehicles and has overseen the disbursement of more than $676 million in more than 84,000 micro, small business, and real estate loans in emerging economies in the Middle East, Africa, Eastern Europe, and Asia. Take a sip before I get back to the United States. So back home in Cleveland, we began our work in 1994. And we came at the invitation of a group of corporate leaders, including bankers, who wanted a specialized solution for blight in city neighborhoods. Those Fortune 500 CEOs of companies like Eaton, Sherwin-Williams, TRW, General Electric, National City Bank, and Key Bank had recently funded the first phase of development in Cleveland that gained us the reputation as the comeback city in early 1990s. They pulled out their checkbooks and raised a fund that seeded the building of stadiums for all of our professional sports teams, the Browns, the Indians, and the Cavaliers, right in downtown Cleveland. Now, this brought renewed energy to the urban core, which had been suffering from flight to the suburbs. The corporate leadership and our then very aggressive mayor, Michael White, then turned their attention to the neighborhoods. Cleveland communities had been suffering from the loss of middle and upper middle class families, both African American and those of Eastern European descent. They left seeking better housing opportunities, lower crime, and better schools. So another fund was raised that was used as capital to start ShoreBank in Cleveland and to fund an intermediary to provide technical support to develop stronger community development corporations. The thought was that ShoreBank could provide the funding for these CDCs, as well as private organizations who would do real estate development and run successful businesses to create jobs in the neighborhood. And I'm happy to report that the original $7 million in capital for ShoreBank has been leveraged to support more than $170 million in loans in Cleveland neighborhoods. We focused on lending to housing rehabbers to undertake single-family and multifamily projects. We did support those CDCs who undertook new housing developments to stabilize neighborhoods. We lend to small businesses, faith-based institutions, daycare centers, and many other organizations that create jobs and the economic opportunities which build strong and healthy neighborhoods and reinvigorate people's lives. We established a nonprofit affiliate, Shore Bank Enterprise, to serve low-income neighborhoods and help jumpstart the entrepreneurs and grow businesses owned by minorities and women who had problems accessing credit. In addition to capital, our nonprofit offers affordable office and production space. One of the most recent additions to the services is discounted accounting services to help their small business borrowers better understand their cash flows. Our work in Cleveland and elsewhere continues and is more challenging given the devastation of housing values and neighborhoods victimized by predatory lenders, not to mention the ongoing economic challenges. Nonetheless, compared to other banks of its size, Shore Bank does 10 times more home lending in distressed communities and makes 5 times the mortgage loans in those communities. Even compared to other banks that are certified as CDFIs, Shore Bank has 3.6 times as much dollar of equity in distressed communities and makes 30% more mortgage loans in those neighborhoods, all the while being subject to the same capital and safety requirements and corporate governance rules as other banks. The social performance metrics developed by the National Community Investment Fund place Shore Bank firmly in the high-performing quadrant of banks, indicating that Shore Bank outperforms all peer groups in both development lending and development deposit intensity. Lending in urban neighborhoods is only part of our core mission. We're also committed to doing our best to multiply the impact of what we do. We want to make sure that any impact extends beyond the loan itself. And we do that by focusing on sustainability and loans that support each other. So let me explain this further with an example. We work closely with the Lemus Child Care and Enrichment Center, a multicultural daycare center on Cleveland's east side. The owner is a 15-year industry veteran who wanted to create an innovative center that introduced children to activities such as ballet, computer classes, foreign language, and art lessons. Shore Bank has a loan specialist for daycare because we believe local child care facilities are a key component to building a strong community. Now, thanks to this center, hundreds of children are able to find a safe and educational home during the day while their parents work outside of the home to put food on the table, send their children to school, and improve their own financial health, which in turn builds a vibrant community. Our mission is our triple bottom line. Not only do we strive to be profitable, but we are equally focused on making sure our services and products have a positive community and environmental impact. Since the mid-1990s, Shore Bank has made the environment a component of our lending decisions, long before green building and renovating became so trendy. I'm very happy that more lenders and builders are joining us in that green endeavor because focusing on green can create a cascading impact. Our focus on the environment began when our bank holding company, Shore Bank Corporation, created Shore Bank Pacific as an affiliate. Shore Bank Pacific focuses on environmentally friendly and sustainable development in the Pacific Northwest. The bank is providing resources and leadership to enable long-term growth and success in the region's organic farming, fishing, and timber industries. The bank has invested more than $100 million in environmental loans since 2007. When Sustainable Harvest wanted to become the international leader in importing and distributing top quality, organic fair trade coffee, the organization needed a major investment. Sustainable Harvest selected Shore Bank because of our track record in serving the organic food industry and understanding the codependence of economic and ecological systems. A $3 million loan from ShoreBank transformed the once fledgling company into a powerful force in the global market. Today, they're improving the lives of thousands of coffee growers and continuing to invest in training and management systems and create jobs. Whole Foods, Green Mountain Coffee, and Pete's Coffee are among their many customers. The environmental focus in the Northwest was adapted and applied to meet the needs of our Midwest and more urban markets. In Cleveland, my goal is to make sure that 30% of our loans annually are dedicated to projects that have environmentally responsible characteristics. For example, we helped retrofit an unused commercial building that is now the first of its kind, a repository and resource center for green building design. In Chicago, the bank funded the Chicago Christian Industrial League's new headquarters, which is a LEED certified housing center. The center not only houses the formerly homeless, it introduces them to new skills and careers in landscaping. One of the most dramatic Cleveland sustainability stories is the Glenville Enterprise Center. When we came to Cleveland, the business plan called for incubator-like developments to draw businesses into the neighborhoods and thereby bring jobs for local residents. The largest development undertaken in this regard by our nonprofit affiliate is Glenville Enterprise Center. In fact, when I first came to Cleveland, that was my first job, to continue to develop and lease out this facility. I referred to it as my baby Huey. So back in 1994, it was a mostly abandoned torpedo factory that sat idle for 15 years. There were 1 or 2 machine shops still operating in a corner, but the rest was in pretty bad shape. So at 10 o'clock in the morning, you might find 10 cars in this massive parking lot. And you can imagine what contamination is left behind from a torpedo factory. With help from local foundations and through much blood, sweat, and tears of my own, the building has been transformed into a vibrant center, 85% occupied with more than 40 businesses and nonprofits located there. And it can be very hard to find a parking space at 10 o'clock in the morning. Tenants include a high-end cabinet maker, a charter school, and our bank. So it went from a brownfield that was an eyesore in the neighborhood to a place where people are making a living and kids are getting a great education. We were the first bank in the Midwest to offer free energy audits to our customers. When they weatherize and install energy-efficient appliances, they save 25 to 50% a month on utility bills, as well as reducing greenhouse gas emissions. An improvement costing $2,000 to $5,000 can save a household 50% in energy costs while adding comfort and value to the home. Due to our promotion and encouragement of lending for green design, we now have one of the nation's most energy-efficient synagogues in Cleveland. The Jewish mandate, Tikkun Olam, translates to repair the world. Leaders at Temple Emmanuel took that religious obligation literally by including energy-efficient and environmentally friendly designs into their newly constructed synagogue. The new temple is significantly larger than the one it replaced, so the congregation added a preschool and a new religious study program. The new larger temple spurred a jump in membership and a 40% increase in school enrollment. When another customer, Chicago's Indy Energy, invests in geothermal construction, it reuses the Earth's materials to deliver efficient home heat while providing green job training for residents of communities that had relied on jobs in manufacturing and the auto industry. These green-collar jobs are good jobs that cannot be shipped offshore and will be there tomorrow. So, we seek to fund companies with a green business purpose. A loan from Shore Bank funded the purchase of efficient technologies for Rosby Resources recovery in the Cleveland area. With the new equipment, Rosby recycles, reuses, or resells 90% of the construction and solid waste, debris, and 100% of all organic materials it collects, up from less than 80%. Rosby is also leading the way for other local businesses to go green. As members of the Cleveland Green Building Coalition, Rosby helps companies qualify for LEED certification. In addition, they relocated one of their companies from the suburbs into a distressed city neighborhood desperately in need of jobs. So this is another example of how our lending has significant impact beyond the loan itself. So we've talked about the numbers, and we've discussed some specific examples describing when and where Shore Bank's approach to lending has a positive impact on businesses and residents. But we haven't yet talked about the how. How are we able to be so successful in distressed communities? More than half of the bank's residential mortgage borrowers have credit scores below 620, technically qualifying them as subprime. While we do look at FICO scores, we don't rely on them entirely in our underwriting. Instead, we do our own inquiry through many personal meetings with borrowers. If you want to borrow from us, we're going to get to know you, the house or the business that you're financing, plus the neighborhood. The key to our success is that we use both a high-touch and tough-minded method of working with our communities. In other words, we do banking the old-fashioned way. Our high touch is labor-intensive. We have property valuation experts. We know the local rental market, so we can advise clients on how much rehab work a property can support and remain affordable. We maintain and lead training for a network of known tradesmen, plumbers, roofers, to keep rehab costs down. We're also tough-minded. We have strict underwriting standards. We verify income. We offer fixed-rate, long-term loans for homes and businesses and avoid the more risky adjustable-rate mortgages. We require that taxes and insurance be escrowed. Our customers often pay us first because they trust us and they want us in their lives. In turn, we trust them and we want them in our lives. And before predatory lending hit our neighborhoods and Wall Street shenanigans hit our economy, our way of banking was profitable. But the triple threat of declining home values, high unemployment, and tight credit has hurt our bottom line. This is not the first recession our bank has weathered, but the extensive impact of this financial crisis has been a game changer because there's simply no model for how banks that did things right can recover from the devastating impact of lenders that did things wrong. Because we now have a domino effect that has disproportionately hurt urban neighborhoods, small businesses, and not-for-profits. Which leads me to the ongoing debate over what caused the mortgage debacle that led to the nation's biggest financial crisis since the Great Depression. The many pundits and experts have many viewpoints here. Some said it was insufficient regulatory oversight. Others said it was bad bank management or predatory, aggressive marketing to cash-strapped homeowners, or lax mortgage underwriting that led to liar loans, brokers gone wild, securitization gone wild. Some said the credit agencies were at fault for not sounding the alarm about the growing risks in mortgage-backed securities, while others blamed the change in the capital gains tax on housing, which gave homeowners and investors huge financial incentives to flip houses every 2 years. And a couple financial columnists said that the biggest culprit was the Community Reinvestment Act because it made banks lend to poor people. Now, you know I'm going to take issue with that. Perhaps the best way to tackle this rebuttal would be to take a closer look at some of the critical books that have been published. As you review this material, the differences between the business practices of some of the largest financial industry players and Shore Bank is striking. First, they sold their mortgages for a fee into the secondary market. If those institutions had a triple bottom line with ways to measure success other than fee income, our nation may have had a different outcome. We originate our loans, keep them, and service them. So if an issue develops regarding a borrower's ability to pay, we get in touch immediately and work with them before the situation reaches a crisis. Second, they sold many risky products, interest only, ARMs, hybrid ARMs. There were hundreds of exotic products available to borrowers. Many of these products are risky because they often don't consider the customer's ability to pay once the initial teaser rate expires. The argument was made, don't worry, you can always refinance when the rate resets. One of the book's authors described a typical subprime loan made by one of the biggest mortgage players. Maria was an ambitious speculator who wanted to get rich quick in the housing boom. Flexible and single with no kids, she started with $30,000 in the bank and carried about $60,000 in student loans. But she had a good job paying in the high five figures. In 2004, she was approved for $300,000 to buy her first investment property. The money was broken into 3 loans, an adjustable rate, an interest-only loan with no money down, and a negative amortization loan. The borrower was 20 years old. These big institutions also work with mortgage brokers, lots of them. In the subprime market, brokers were substantially more common than in the prime market, 71% subprime versus 50% in prime. Brokers offered mortgages that at first glance seemed cheap, but often turned out to be high-cost predatory loans. For 2004 through 2006, high-cost loans constituted 31% of the loans made in Chicago. In Cleveland, I recall many of my loan officers complaining that they lost another good customer to a mortgage broker. Loans through mortgage companies that are not depositories are not covered by CRA. It's good to know that when all is said and done, the nation's top bank regulator, the control of the currency, John Dugan, summed it up best in November 2008. CRA is not the culprit behind the subprime mortgage lending abuses or broader credit quality issues in the marketplace. Dugan also pointed out that loans made by banks through CRA-related programs can perform at or above levels of standard conventional mortgages. We would concur. Despite having more than 80% of our loans to low and moderate income communities, our loan losses in 2008 were less than 1% of outstanding loans. Dugan also said CRA programs help encourage greater private investment in areas where such development otherwise would not occur. He said CRA projects also act as catalysts for other investments, job creation, and housing developments. He concluded with this statement: in today's difficult economic environment, the need for the positive results that CRA has generated is now even greater. We at Shore Bank couldn't agree more. Each foreclosed home drives down the prices of the remaining houses. The home values of adjacent properties can decline up to 9% for each foreclosed home. So you can see the pain can spread quickly. A study by the Woodstock Institute shows that minority communities have a far greater difficulty in recovering from foreclosures. The properties sit longer on the market, and the sales price declines more dramatically. At the end of 2008 in Chicago, the price decline in African American communities was 18% higher than the city as a whole. So, where do we go from here? We can begin by leading the economic recovery. Following the principles and mission of community banking will help seed the recovery. In Ohio, members of a task force of state legislators and development advocates recently said that Ohio's 32 urban centers are the backbone of innovation, commerce, and quality of living. The task force also concluded that redeveloping and strengthening our cities is critical to ensuring future prosperity for Ohio as the national recession lifts, because the benefits will spread throughout the region. We already have many successful examples of how collaboration between banks and nonprofit organizations and effective use of partnerships can pave the way for inclusive prosperity. The Greater University Circle initiative in Cleveland is a collaborative effort between the Cleveland Foundation and several nonprofit partners, including ShoreBank Enterprise. This project has seeded businesses located in distressed neighborhoods so they can, one, create jobs and equity opportunities in these cooperative businesses, and two, supply goods and services to economic anchors such as major hospitals, schools, and art organizations. To me, this is the perfect example of how to spread the positive effects of a city's strengths into challenged neighborhoods. One of the businesses is a commercial laundry that uses green technologies and hires neighborhood residents as worker owners. Many of these individuals have criminal records, but they're motivated to work in a place in their own neighborhoods where they can earn an ownership stake. The laundry is located, by the way, in an outbuilding at ShoreBank Enterprise's Glenville Enterprise Center. And what is the business proposition? The primary customers are major institutions, hospitals, and a university located in the adjacent, prosperous University Circle neighborhood. Another example of such collaboration is how we're working with the MacArthur Foundation. You may be most familiar with MacArthur as the organization that awards the annual Genius Grants. I'm sure mine got lost in the mail. The foundation has deposited $15 million with ShoreBank over a period of 10 years. The collaboration with the MacArthur Foundation, along with F.B. Heron Foundation, represents work on two programs that we've initiated since the recession began. The money the foundation's deposits will be used to support the Rescue Loan Program and the Capacity Plus Loan Program, which help people refinance high-priced mortgages and assist struggling nonprofits. For the nonprofits, these loans often are a lifeline to fund operations while they wait for the next grant. Since its inception, the bank has worked to attract capital from beyond the neighborhoods it serves, originally through a program called Development Deposits. The continuing success of raising deposits over the years absolutely helped ShoreBank reverse the flow of capital. Let's call it greenlining instead of redlining. It's the industry of socially responsible investing, which is a critical resource of capital for community investing. Banks like ours import capital by gathering deposits from a national marketplace and by deploying them as loans in the communities that we serve. The nearly 60 CDFIs like ShoreBank have invested billions of dollars in underserved areas since the early 1990s, made possible by these mission-driven depositors. But there's so much more work to be done. Individuals and organizations in urban communities need more programs and funding to access capital to realize their economic potential. And your support would go a long way. And it's easy to get involved. We have many programs that allow individuals and institutions to participate. If you're a foundation, you can make greater use of PRIs, or program-related investments. Excuse me. Think of your resources as social investment capital, in addition to sources for charitable giving. PRIs can be structured in a variety of ways, such as below market rate loans or equity investments. The capital from PRI equity investments can be greatly leveraged, creating more than 3 times the amount in new credit in a community. Institutions and individuals can invest in our LINK program. These are products such as CDs, IRAs, and money market accounts, where the deposits offered at a competitive rate can be directed to fund specific purposes, such as environmentally friendly projects, nonprofits, or affordable housing. And of course, institutional investors can invest directly in community banks. TIAA-CREF, the retirement vehicle for the teaching community, has invested nearly $50 million in community banks across the country, including Shore Bank. So finding better ways to serve low and moderate income customers and communities, in case you haven't noticed, is my passion. But I don't expect it necessarily to be yours. However, there is a growing need for concerned business leaders who will create the world that we want to live in. Money is such a powerful force in the world. And when you link that with community values, it will change the world in a very positive way. So I encourage you students in the audience to think about a career in community development banking or socially responsible investing. But whatever profession or endeavor you choose, I do hope you will understand that we're all in this together. When foreclosures go up, crime goes up, property values go down. A rise in foreclosures means more people must turn to entitlement. When you stop rehabbing city buildings and retrofitting for energy efficiency, demand for heating oil rises, driving up costs. So if we can all begin today by considering how you personally can reach out, either for the first time or as a repeat supporter, to a financial organization that is committed to revitalizing neighborhoods, restoring wealth, and getting residents on a better path while also meeting the needs of investors, then I will have been successful in fulfilling my passion today. Hands-on hard work and collaboration must continue in order to create the rich product line, services, and deposits that the investment community and community development banks need to ensure that CDFIs like Shore Bank have the funds available to meet the growing need for our credit in neighborhoods. I'd like to close by quoting Federal Reserve Board Chairman Ben Bernanke, who spoke last year before the Global Financial Literacy Summit in Washington. He said, "As the effects of financial crisis and the resulting downturn have spread, there has been increased focus on preserving the gains made in low and moderate income communities. Accomplishing this objective requires preserving the institutions that help build these communities. Without strong CDFIs, attracting investments and capital to rebuild and revitalize communities would be even more difficult." He said, "Economic recovery, like economic development, is a bottom-up as well as top-down process. Through their work at the community level, CDFIs, together with other community development organizations, can help build a sustainable recovery for us all." It's been my pleasure and honor returning to Dartmouth and speaking with you today, and I thank you for your attention. Q&A? Yes, ma'am.
One of the things that really bothers me in kind of the crisis or in thinking of the solutions is financial markets are very complex. And then when you look at how much people know, they actually know very little. They can hardly make 2% calculations. So when you look at the minorities, the problem is 3 times bigger because often minorities are low income and low education people. So how, when you offer contracts, you really want to make sure that people understand them, in particular when they are so complex. And so being on the supply side and being a banker, how does Shore Bank address and face this problem? Because, those people, you might offer good contracts, but at the same time, these people can turn around, and in case of difficulties, they go to the payday lenders, they charge 3,000%. So, they can easily offset, some of the goods that you have done. And, we also need to empower the individual and perhaps not just fix the structure.
Right. You're absolutely right. And what we do generally is to partner with nonprofit organizations that are in that business, like Consumer Credit Counseling Service, for example, where we go in and we tell them, if someone comes to us and they clearly don't understand what it is that we're proposing or that they think they want to do, or even bring us in like this term sheet from somebody that's put a flyer in the door for a predatory loan, we send them elsewhere to get that counseling. And I guess the part that makes us different is we'll take the time to do that versus just sort of giving them a no, or or even making our lobby not friendly enough to think you can even come in if you have a question. So I think our loan officers go the extra mile to make sure people have full information. It's tough as a bank to fund all that on your own. That's why partnerships are important. I mean, our margins are pretty tight, so while we would love to have individual counselors for everyone, we can't. But we make it our duty to figure out the good nonprofits out there that are able to counsel people in the right direction. Yes, ma'am.
In the past, when I have thought of Cleveland, I must say I don't think of it in the terms that you described, and probably because I have a lot of stories in my head from my uncles who worked in the automobile industry in Cleveland, and they watched the city deteriorate.
So you think it's worse than I said?
Okay, no, I'm going. But,
Okay.
but listening to you describe it, I have a different view of Cleveland. What gave you and your bank such faith in the poor neighborhoods of Cleveland to make the investments that you're making?
Well, a couple things. First of all, the way that we do business, I think I said in another meeting, we don't invade, we're invited. So one of the reasons that we had faith is that the corporate community had come together, these Fortune 500 company CEOs, and literally stroked a check to raise the capital to have us come. And we could also see that it was part of a more comprehensive approach. Again, the first thing they did was try to get downtown back. So, building those 3 stadiums, I mean, I can't tell you the difference that made, because all the stadiums were out in the suburbs, so people would come into work and Cleveland would look like a ghost town after 5 o'clock. There was no reason anybody wanted to be in the city. This drew people back in. It spurred other development around. So now you've got this little core of activity, at least, going on in the central city. So then the strategy to work on the neighborhoods after that, now that you've got some energy going, how do we then sort of plug the neighborhoods into that, to us made a lot of sense. The other thing about Cleveland that was so positive, and I still haven't run across another community in the U.S. that has such strong community development corporations. I mean, these are sophisticated developers, these nonprofits. They're doing huge housing developments in very sophisticated ways. So we knew that we had some good partners on the ground as well, and that we would not have to start, sort of from the beginning trying to build up some capacity to do the type of development. Cleveland's got a lot going for it. The work ethic there, I mean, you got a lot of Eastern European, you got a long history of sort of African-American leadership, starting with Carl Stokes, back, first African-American mayor of a major city. So there was stuff to build on. We just had to figure out how to change our thinking about what Cleveland was going to be. It was never again going to be predominantly manufacturing job driven. It had to be something else, and we felt like entrepreneurship and supporting the neighborhoods was part of a plan that was already being thought through. Come on over. Plus, we could only go up from the river burning, right?
I have two questions. The first was a follow-up on Anna Marie's question, and it is the counseling that you do maybe after to your borrowers as they might run into trouble, because I think that's a very labor-intensive activity, especially for the kind of borrowers that you're lending to. And so what, is that also a partnership, or are there other kinds of activities or programs even that you engage in to keep the loan alive rather than turning into a default?
Well, once it's my loan, it's mine for real, so I can't hand it to anybody. And we've become very good at what we call troubled debt restructures, which is an actual term within the regulations that says, you know, you can take a loan, for example, you might figure out that when you made the loan, you're lending 80% of value on a property, all right? So that's all fine, you're going along just fine. Then that borrower loses their job. So all of a sudden, it's in default. So now you got to go back in and do another appraisal and say, okay, what's that home worth now? Because it's looking like I might have to, you know, liquidate that to get my money back. And then you find out you're upside down. You know, now the loan is 110% of what the current value is because of all the reasons we talked about deteriorating the neighborhood. So then the bank can go in and say, all right, let me look at your cash flow borrower. Let me look at the loan to value. And I'm going to just whack off, you know, $20,000 off of this loan. I'm going to whack that off and make that a note B. The note A is going to be of the right loan to value, of the right payments that you can cash flow in your current circumstances. And if you pay that for 6 months, now I get to return this to a performing loan, at least that part of it. The note B is a hope and a prayer. You know, I got to write it off the minute that I do it. But, you know, maybe someday if, you know, your rich uncle, we don't want him to die, but let's just say they had a generous moment and stroked you a big check, then, you know, maybe that gets paid. But the regulators look upon that favorably because you took action to try to right-size the situation versus just sort of letting it go in default. They know we can't control housing values. I mean, they're just things that we can't control. But, you know, we've gotten pretty good at restructuring so that, you know, some portion of the loan at least can be kept current over the long run.
If I can, my second question, sorry, were there people? Was on the Community Reinvestment Act. And so you talked about how that has been under attack. I mean, it was under attack, it seems like, before.
Forever.
Yeah, forever, exactly. So, and just what are your thoughts on that? And is that going to become further under attack, or how protected is it in the current environment?
You're asking me to predict DC? I think there's so many other problems right now that are overshadowing that, and you know, it would be hard to stand up here and make the argument that that was everything that happened. If every poor person in America had a mortgage and defaulted on it, it couldn't have made as big a mess as what just happened to us. So it's not even credible to sit there and say that that's what happened. I do think that there'll be well-deserved scrutiny on the practice of bundling high-risk loans. I mean, I never got that. So you're going to take 100 risky loans, put them all together, and then rate them as a high-performing security? You know, I mean, I think that stuff is probably going to get a lot more attention right now than CRA, I hope. And, you know, there are banks that have seen the light. I mean, there are banks making money lending in some of the neighborhoods that they never would have lent to before because of their assumptions. So it's become more of a standard business practice, I think, with some of the banks, especially the regional type banks. You know, they figured out you can make money at this, which is part of what we were trying to demonstrate all along. So even if it goes away, hopefully there'll still be banking resources there because it makes sense for them. Yes, way up there.
Banking and the community development, everything you do is subject to a lot of regulation.
Mm-hmm.
And so if you're interested in results, I was wondering if you had a short list of one or two regulations that banking and construction are subject to a lot of regulation. And if you were interested in outcomes and results, as you are, you might have a short list of regulations that, if changed, would increase your multiplier effect or allow you to get twice as much done with the same amount of capital. I just wonder if you'd share your perspective on that, or even the specific regulations.
Well, I think there's been some progress along the major line that I would cite, which would be the regulations that force a bank to charge off or write down a loan the minute that it becomes delinquent and it's known that the collateral isn't there to support it. So like the situation I just talked about, you know, when you did the loan to value was fine. Loan gets in trouble, come back in and do a new appraisal. Well, before, whatever that gap is, let's say you got a $40,000 gap on a $120,000 loan, you got to write that off right now. Just gone, poof, no chance to do anything. Even if you're working with the borrower, even if it doesn't look like liquidation is the way that you're going to get out of this loan. Fortunately, with the TDR structure that I described, now it's a little bit, it's not automatic, but that's still spotty by regulator. You know, one regulator might believe in you know, the TDR structure, and another one may not, so they can still beat you up about that. So I guess I would say any reg that makes that acts like you're not going to do anything when things go wrong. You know, it's kind of like shock. You know, you do a shock. What do you call that? Yeah, stress test. It's like, okay, if the world blew up tomorrow and you did nothing and sat here like this, what would happen? Well, guess what? I mean, of course everything would blow up. But to take a reasonable thought about what you might do to try to work with that situation, I think is the right way. And I feel good that we're moving in that direction. They were going to blow up every bank in America otherwise. You know, we just really couldn't afford to do that. Others? Yes.
It seems okay. It seems like a lot of the investments that were made for like Shoreline Bank were on part good faith investments. You're talking about like the Fortune 500 companies.
Yeah.
Do you see, given the financial situation, a trend towards those types of investments being made? Do you see a backward trend? Are you optimistic about the success of your type of bank kind of spreading in light of its successes, or?
I get it. It's interesting. I think the days of pure altruism, you know, put money in and, you know, maybe I'll get it back in 30 years, maybe I won't. I can sit around a long time for you guys to try to figure out what's going on. I think those days are next to gone, close to gone. They're still very mission-oriented folks. There's some very sophisticated foundations that can put money in for long periods of time, but the average investor is probably not going to do that. So our industry has to figure out the liquidity question. We have to figure out how to, we can make a return. We can have the stock appreciate. You know, we can demonstrate that when you put your money in, the bank had this much in assets, and now it has this much in assets, and therefore your stake is theoretically worth, you know, this much more. But the problem is we don't have a marketplace to sell it. Who's going to buy it? You know, now we got to go out and try to find some other individual, somebody that's the same minded that, you know, rather than just call up a broker and say, okay, I've got X number of shares, put on the stock market and see what happens. So the challenge is for us to create liquidity and secondary markets for that. And I think that everybody in the industry realizes and recognizes that. And I think we can do it. It's, you know, we've had the luxury of not having to worry too much about it for a long time. But now we really do have to figure that out. And in a way that doesn't compromise our mission. I mean, we could go public tomorrow, but then we might have a room like this full of shareholders saying, well, forget that mission stuff. I want, what's next quarter's profits? So that's the balancing act. Ron?
But does that mean that the fertile ground for you is the TIA Crefts of the world, the big portfolioed kinds of investors?
Yeah, I mean, yes, that is what that means. But I also think, just like we have an online savings product now that we just started maybe a couple years ago, and we've now got $250 million worth of that. And these are individual savers, because what we're going after are those people that have the environmental issue as something that they're looking for. So I do think that there are individuals, more and more individuals, as they go about managing their financial life, they're trying to do socially responsible investing, meaning they want to match, they want to put their dollars places that support their own values. So I do think that that's a big market. It's a little different on equity, though, versus savings. So on the equity side, I think it's still going to be the big players for quite a while. Oh, one more, okay.
Stephanie, you mentioned, or you encourage students to potentially pursue careers in community development banking.
Mm-hmm.
Any thoughts on what types of background experience might be most beneficial?
Well, my degree's in economics. That certainly served me well. I think it's just being able to understand the fundamentals of business, in the sense of, what is the balance sheet? How does the balance sheet work? How does how does a P&L, a profit and loss statement, work? And at the same time, anything that encourages you to see the complexity of what has to happen to make any particular neighborhood prosper. We were talking about that a little earlier today. I mean, you got to know when you push this button that this one's going to pop out, and just have your mind around the fact that you can't do it on your own. There have to be players attending to various aspects of a community development, and you need to have respect for that. If you think that you have all the answers and that you're smarter than most when you walk in the room, and you're talking to people that have been working in these neighborhoods for 20 or 30 years, you got another thing coming. So anything that prepares you to see complexity, to accept it, and figure out sort of what your role is in moving something forward. People that would want to analyze for long periods of time probably wouldn't make it, because things change fast, and you need action. You need little victories to keep the ball moving forward, versus you can sit in a room all day long and never come up with the perfect solution, short of starting to take an action in an informed way, but do something, and if that doesn't work, do something else. Oh, okay, one up there and then Ron.
Hi, I'm trying to get my hands around how you sort of measure success, because certainly you use a lot of non-financial metrics to sort of, you gave us a lot of non-financial metrics to sort of talk about, number of houses rehabbed, and which, I think is great. But I think one of the sort of paradigms that, I kind of struggle with is like, how can you sort of like do good, but also sort of like, make money, because you have to make money in order to sort of stay in business. And, in order to sort of attract investors, like you see all of these like socially responsible investment funds, like all of these social responsible products. And so how do you sort of like compete with those other products, but still continue to, do the work that you do?
Yeah. So when I sit down for evaluation at the end of the year, the three major components are, did we hit our return goals? And we try to have similar return to our peer banks. So if, banks that are $2 billion or less are, returning, 75 basis points or 1% on assets, then that's what we want to do. We want to try to hit the same, pretty close to the same financial goals as everybody else. Second thing is, I get asked, how much lending did you do that would fit a community development description? Meaning, was it in the target neighborhoods that we are focused on? Was it to a minority-owned business? Was it to a woman-owned business? And so there are goals set out every year to make sure that 90% of what I do, fits that criteria. So did I hit that or not? And then third is around sustainability and environmental loans. At least 30% of my loans every year have to have that component to them. So was it a rehabber that I can document, use recyclable materials, and and did high energy efficient equipment in the rehab project? So we look at all three of those things. Profit is one of them. And like I said, we've got some challenges right now, but it's mostly because of the delinquency rates caused by huge unemployment in some of the areas we serve. I think I said in the class earlier today, one of our neighborhoods in Chicago has the second highest unemployment rate in the nation. What can you do about that? There's not much you can do about that. Before the economy tanked, we were rolling along just, kind of just fine. The fundamentals of our business are sound. What gets you, in banking, period, but especially for us, since we have such a focus on lending, what gets you is the quality of your loans. Once those start to default, just so you know, so you're bored stiff or have a nightmare like me, when a loan becomes delinquent, you have to provide a certain provision for that loan. So, let's call it a $100,000 loan. If you think you got half a chance at collecting it, and you can only document that you have half a chance at collecting it, that means that other $50,000, you got to write down just like an expense, just like I just wrote you a $50,000 check, which comes right out of the bottom line for your company. So delinquencies and the quality of your assets are the toughest thing that any banker has to manage, and certainly in our situation, even more challenging. But we're not alone. I mean, this is the stuff you're reading about with these major banks all over the country. Ron?
My question was along the same lines of good versus well. And you mentioned as a privately owned corporation, you can do certain things and operate in a certain way, but as a publicly held company, you'd be different. So my question is more than this. Is this about the right scale? Is roughly a $2 billion privately held enterprise about the right size for something like this?
It depends. Depends on what's going on, with your credit quality especially. The real question is, could you get bigger? Right. Is there some scenario where you could envision being able to sell stock in a way that, you could really get a bunch more capital in there to leverage? It's untested, but I think it's possible. I do. I mean, because
there are no regulatory limits that would hold. Sorry, that's
as much capital as I can raise to do what I do and stay within, sort of certain performance metrics, I can do it. Yeah. The CDFI legislation does not have a cap on it. It doesn't say you can only be so big and still be a CDFI. So it's the capital is the question. Can you figure out how to get in enough money that doesn't cause you to change what you're trying to do? And I'm actually hopeful about that, because I think that the world is moving more and more in the direction of understanding sort of the interdependency of everybody being able to do at least okay. I mean, not everybody has to be super rich, but it's a heck of a drag if half the country is, in really bad shape. So it makes more sense to figure out how to invest in that versus how to continue to make up for it or subsidize for it. I'll let you know in a couple years. Andrew.
A couple more questions about the ownership of the bank, and maybe I'm just sort of confused about what I'm expecting, but
Okay.
if you get capitalized by a bunch of nonprofits or foundations, I mean, how does that affect their tax status? since you're a for-profit entity. I guess the second thing is that if you're worried about control of the bank, I would expect like Shore Bank to be very active in issuing preferred stock and the
Right.
like to sort of bring in capital without ceding the control. It would seem like that device is really important for your type of organization.
Right, and you're right about that. That is ideal. You know, put in equity and don't tell us what to do. That's perfect. And there's a limited audience for that. I mean, when you think about the equity market, I mean, how many more people want just pure stock versus will deal with, you know, sort of preferred and not, you know, not really worry too much about the ownership or the true exit even for that matter.
Well, the TARP money was
Yeah.
in the form of preferred, so it was sort of good for the government and good for Warren Buffett.
Right. We like TARP. And in fact, you know, there's recently been, as you know, another allocation of TARP for community development banks. Duh, who's going to start lending again in the neighborhoods, you know? Come on, you know, why should just the big guys get the money? So we like TARP, and we're, you know, going to have our little place in line there. In terms of the other types of investors, so a foundation can always do a program-related investment, for example, which they do with their corpus. I mean, that's not part of their granting. It's part of the whole core that's funding the foundation, that they make an investment in us just like they would in some other market expecting a return. So that's how the foundations get away with it. The companies that we've had a lot of big banks, as a matter of fact, come in as equity shareholders with us. So I hope none of them see this on YouTube and think I was beating up on them. But, you know, they get CRA credit, right? Community Reinvestment Act credit for their investments, which, you know, they have to satisfy those requirements every year. So they tend to be patient with that capital, you know. So that takes care of them. And then private companies can do whatever they want. I think our biggest investor is actually an insurance company. And, you know, they're in it because they, well, YouTube again, I won't say, but, you know, there would have been a chance for something like CRA to happen to insurance companies, but it hasn't happened so far because people are, you know, behaving better and showing that they're being responsible parts of the community. So that's sort of their rationale, I think. All right, we done? Okay, thank you. Thank you.